Hello everyone, let me introduce myself. My name is Andhika Pratama from the University of Technocrat Indonesia, Faculty of Economics and Business, Accounting Study Program. Here I will explain what the basic equation formula is, accounting and case study examples of accounting equation formulas. Understanding the basic accounting equation. The basic accounting equation is a calculation that aims to project the relationship between debts, assets, and capital owned by a company. The principle that is always held in accounting is the balance between income and expenses. Then, both of these things need to be analyzed in more detail with the basic equation accounting, which is also used to assess the company's ability to manage finances. Therefore, the assets owned by the company must be balanced with the liabilities or obligation. This shows all the assets of the company obtained either from debt or equity funding. For example, when a new company is established, the first assets purchased come from funds received from investors or from loans, debt. Thus, all company assets originating from creditors or investors are called liabilities and equity. The example formula for the basic accounting equation is as follows. Assets equals liabilities plus equity. Or it can also be assets equals liabilities plus capital, liabilities. As you can see, the asset side is equal to the sum of liabilities and owner's equity. This makes sense if the mindset is that liabilities and equity are essentially just sources of funding for a company to purchase assets. This equation is generally written with liabilities placed before owner's equity, because debts to creditors must be paid off before investors when the company goes bankrupt. In other words, liabilities are considered more current or liquid than equity. This is consistent with examples of financial reporting where current assets, and current liabilities, are always reported before fixed assets, PPE, and long-term liabilities, long-term debt. This basic accounting equation example applies to all business activities and transactions. Assets will always equal liabilities and owner's equity. If assets increase, either liabilities or owner's equity must increase to balance the equation. Likewise, if assets decrease, liabilities and owner's equity will also decrease. Components of the basic accounting equation. 1. Assets. Assets are resources owned or controlled by a company for future use. 2. Obligations or liabilities. The second component of the basic accounting equation is obligations, or commonly referred to as liabilities, which is the amount of funds that the company borrows from another party, creditor, and must be paid off according to the agreed time. 3. Equity. Equity is the portion of a company's assets owned by shareholders or third parties, and is included in the basic accounting equation formula. Example of basic accounting equation for machine purchase with cash. Example of basic accounting equation I, PT, Anjungan Tunai Mandiri will buy a machine priced at 700,000 Indonesian rupiah and only use cash. Based on these conditions, the transaction that takes place can result in a debit to equipment, plus Rp 700,000.00, and a credit to cash, minus 700,000.00 Indonesian rupiah. For example, the basic accounting equation for these transactions only affects the assets of the equation. The result has no effect on shareholders' equity or liabilities on the right-hand side of the equation. That's a little explanation from me, thank you.